Hello everyone, it's Friday, September 12th. Today we're analyzing the euro and British pound charts to gauge potential market trajectories. Yesterday the euro slipped after the release of US consumer price data, but demand soon recovered as buyers took advantage of the correction. The figures had little impact on overall sentiment, reinforcing expectations that the Federal Reserve will likely cut interest rates as early as next week. US consumer price rose by 0.4% in August versus a forecast of 0.3%. The small upside surprise was not enough to sustain the dollar's rally. Annual inflation accelerated to 2.9% from 2.7%. Core prices held steady, rising by 0.3% month-on-month in August and 3.1% year-on-year. Taken together, data point to an imminent Fed rate cut. The European Central Bank also announced its policy decision on Thursday, leaving the key rate unchanged at 2.15% as expected. ECB President Christine Lagarde's remarks and the accompanying report prompted many economists to rethink their outlook. They no longer see signals or urgency for further rate cuts, suggesting that the easing cycle, which began last year, is now over. Instead, policymakers may start weighing in rate hikes. Many believe that current borrowing costs could stimulate economic growth and lift inflation, which would eventually compel the ECB to tighten policy. Now let's turn to today's macroeconomic calendar. The UK will release GDP growth, industrial production, and goods trade balance figures. The economy is expected to show no growth in July, while the 3-month GDP average is forecast to slip to 0.2%, which is a troubling sign for Britain. Industrial output is also projected to stagnate, meaning that weak data could add further pressure on sterling. And the euro area traders will be watching consumer price data from Germany and France, along with Italy's unemployment rate. Stronger than expected numbers could lend support to the euro. As for the US, today's calendar is light, with only the University of Michigan's readings on consumer sentiment and inflation expectations on the agenda. A decline in inflation expectations would likely weigh on the dollar, giving risk assets room to strengthen. Turning to technical analysis, the 1-hour EUR USD chart suggests that a false breakout at 17.28 would generate a buy signal, lifting the pair to 17.60. A breakout and consolidation above this level could extend the move toward 1.1812 and potentially 18.66. At this level, I would recommend going short on the rebound, targeting a 25-30 pip move. Short positions at 17.60 and 18.12 should only be considered in event of a false breakout, with a target near 1.1728. For now, it's premature to call for a sustained bullish trend as the pair remains locked in a sideways range. Yesterday's inflation release triggered only a muted response, leaving the euro range bound. A bearish scenario would materialize only if the price breaks through and holds below 1.1728. This would open the way to 16.96 and possibly 16.68. At this level, long entries on the rebound would be justified, aiming for a 20-25 pip correction. Going long at 16.96 and 17.28 would only be relevant in the event of a false breakout. As for the British pound, the key test for bulls will be defending 1.3551. A false breakout at this level will generate a buy signal, with sterling likely climbing to 35.87. A breakout and consolidation above this mark could extend gains to 36.15 and even 36.43. At this level, it would be wise to go short on the rebound, targeting a 25-30 pip pullback. Short positions at 35.87, the upper boundary of the sideways range, and at 36.15 should be considered only in the case of a false breakout. If buying momentum fades and the price holds below 35.51, sterling could slip to 35.24, the lower boundary of the range. At this level, long positions on a false breakout would look attractive. Alternatively, going long would be appropriate on rebound at 34.95 in anticipation of intraday correction of 25-30 pips. Best of luck to all.